to bring on board the man of the moment, SBI Chairman, Mr. Dinesh Khara, to talk about his view on the economy, interest rates, inflation, more importantly, what a great year it's been for State Bank of India. For shareholders of SBI, FY23 will be remembered as a real blowout year in terms of profit and stock outperformance. Mr. Khara, good morning. Thank you for joining us.
Good morning, Nikunj.
Mr. Khara, let's understand the big picture from you. The credit growth what SBI reported for the quarter gone by was in double digit, 17 to 17.5%. Looking at the state of the economy, inflation and global turbulence, are you getting a sense that things for FY24 could slow down?
The year we are closing today, of course, have witnessed a phenomenal growth in terms of the credit, and as also it has been very broad-based growth. It is not confined to only few sectors. But I think the way the trends are looking like, it is actually quite positive, I would say that. And I would say that the trends which are there in terms of the outstanding proposals which are still being processed. So also the sanctions which you have given and which have yet to be disbursed. So all said and done, I would say that as far as the credit is concerned, there's a very clear visibility of the growth in the coming year too. And if we look at the broader macro, the demand seems to be something which is quite encouraging, and it is both in terms of retail as well as in terms of corporate. The kind of investment commitments which are shown by various private sector entities and also by the government of India in terms of the infrastructure focus which is there for the next financial year, which has been indicated in the budget. So it's about 10 trillion plus as far as the budget itself is concerned, plus 2.4 trillion from the railways. And invariably, the infrastructure spend has got a significant multiplier effect. So I would say that in view of all this, it is, I would say, the year coming in, the financial year 23-24, we expect a fairly good growth opportunities. And I think we are quite hopeful that we'll get to see decent growth in credit too in the next year.
Can I safely say that in terms of credit growth, a number which everybody wants to understand right at the beginning of the year, because it's the most important number for SBI shareholders and for markets per se, you expect the growth momentum of 15 to 17% to continue?
Yeah, I would say that around 14 to 16% is something which I've been maintaining. So I think we should be in a position to clock growth somewhere around 14-15%.
We have seen a big surge in interest rates, and historically we've always maintained that the first uptick of an interest rate cycle is always beneficial for the banks because deposits they get repriced slowly. Would you get advantage of that, sir, also in FY24?
Yeah, I expect that we will have a fairly decent advantage which should be accruing to us, because when it comes to the way our loan book is stacked, about 34% would be in EBLR and 41% in MCLR. And MCLR also is equally spread between 6 months to a year. So there would be, we still have some elbow room for passing on the interest rate. So I think it will give us an opportunity for NIM expansion for some time to come, even if the policy rates stabilizes around where it is. So I think having said that, I would also like to mention that even in the last year when we have seen so much of clamor for the deposit by various entities, our cost of deposit would have gone up just about 7 basis points in all. So I think that gives a very clear leverage to us in terms of our ability to generate better NIMs in the coming year too.
So do you see the gap between the deposit growth and the credit growth narrowing down? Because that in a sense has been a concern for the banking industry per se.
Yeah, what we have seen is that the deposits are growing at about around in the range of about 10% or so. But at the same time, credit has witnessed a growth of about 15-16% last year. So I think it will, as I was indicating, that we are expecting credit growth of about 14-15% in the coming year. And likewise, we expect that even deposit growth should marginally improve. And having said that, I would also like to mention that our credit deposit ratio, even as of now, if we look at our domestic book only, it would be somewhere around 66-67%. So it actually gives us enough elbow room to really build up our book without really compromising on our cost of resources.
Can I safely connect the dots here, Mr. Khara, and say that SBI margin expansion run will continue?
Yeah, I'm hoping that as the situation stands, we should have opportunity for NIM expansion in the coming financial year too.
Automatically means the magical number which you've achieved for FY23. My sincere compliments for that one, the ROA of 1%. So for FY24, the threshold now becomes 1%. ROA 1% तो रहेगा ही रहेगा.
Yeah, that will be our effort also. We would like to keep it sustainable ROA of more than 1. And also we'll try to improve our ROE too. So that will be these are the key metrics which I monitor very closely. And of course, I'm quite hopeful that we should be in a position to really do well on these two metrics.
Sir, I distinctly remember on the budget day you came out and you calmed the market about your exposure to Adani Group of companies. Any update on that? Any update in terms of the debt repayment, loan repayment? Is everything as per standard account?
Yeah, everything is standard. They are maintaining their repayment obligations, and what they have indicated, the major challenge which was apparently seen by the various players in the market was essentially relating to the loan against shares. And as I sense that they have already repaid the loan against shares, and of course these loan against shares were essentially raised from either from the NBFCs, or they had raised these loans against shares from the international banks. So I think as far as we were concerned, we had not extended any loan against shares, but they are maintaining their repayment obligations. And as far as the cash flows are concerned for all their entities, they are absolutely intact. Rather, there is no challenge whatever is there for the loan book of the banks, as far as this particular group is concerned.
So your exposure to Adani Group of companies was less than 1%, which is well below the threshold limit. Would you be okay to increase your exposure to Adani Group of companies if there is a need arises?
I think for the time being, we'll have to wait and watch as the situation stands. But I believe as of now, they are more into the. I think they have not really approached us for any kind of increase. So it's the question is not there at all. But I'm sure whatever repayment is happening, they are maintaining their repayment schedule. So we'll evaluate the proposal as and when it comes, because when it comes to the lending, as far as banks are concerned, we lend against the assets, and also we lend on the basis of the cash flows, which are very evident. So we will make very, very clear assessment, and based upon that, we'll take a call.
Such a brilliant point. I remember Mr. Khara came out and clarified which stemmed the stock fall in Adani Group of companies. I'm just sharing with the viewers that SBI and bankers, they lend against cash flows and against the assets, not against the equity price. So what happens to equity price is secondary market operation, not what something banks are bothered about. So we should not connect the lenders here and assume that what's happening in a group of companies, equity stock valuation will have impact on the stock price per se. But Mr. Khara, there is one concern at a global level which is now coming up, and that concern clearly is surrounding around 81 bonds. How do you see the implications of that would be for banks like SBI?
Well, of course, this concern has been there for quite some time, but what we have witnessed is that last year, apart from the concerns, even there were some valuation norms also which were a cause of concern. But nevertheless, we have observed that for well-managed, well-rated banks, we are getting enough demand for 81, and this year itself, we have raised more than 15,000 crore during the financial year 23. And we have raised it at a very, very competitive pricing. So I think that is a very clear reflection that 81 investors are looking for the quality paper. And once they have got a confidence, they are willing to pick it up too.
Mr. Khara, after the new finance bill, there is a view in the market that money into debt mutual funds will start drying up. And on the margin, that will benefit banks and money will go back to fixed deposits. Now, you understand the mutual fund business, sir, more than anyone else. So, connect the dots for us.
Yeah, I mean, the way I look at it is, when it comes to the duration funds, essentially, where the long-term capital gains was available in case of debt mutual funds, the amount of that, because today the mutual fund industry is around 40 trillion Indian rupees. And out of that, my sense is that the debt fund should be, a debt fund which will have an impact of the long-term capital gains would be somewhere in the range of about 3 to 4 trillion, not more than that. And banking system is about 215 trillion odd. So if we look at the total basket also, it would not be more than 1% of the total banking system deposits. So how much of that will really impact is to be seen. The other aspect I would say is that mutual fund as an asset class is actually a different asset class as compared to the bank deposits. It will have some impact, but it may not have very significant impact, if I may say so. And apart from that, what I have also observed over the years is that it's an initial reaction only. Eventually, everybody recalibrate themselves or their asset allocation based upon the ground realities of the taxation laws of the country. So I think that's why I would really look at this particular aspect of capital gains taxation, long-term capital gain taxation of the debt funds.
So allow me to switch gears completely and talk about the home loan market. Now SBI has been a disruptor there. SBI in a sense now has the highest market share and SBI has got one of the most commanding rates. Do you see going forward more and more aggressive pricing in the home loan market?
Well, I think it's more of an opportunity which people look at it. But important aspect to be kept in mind is the risk should be rightly priced. The aggression apart, the risk should be rightly priced. So I think there's a very, very clear requirement in terms of understanding and assessing the risk and also keeping in mind the cost which is required to be incurred for sourcing, for servicing, for processing, and for overall administrative control of such accounts. So I think each entity must look into various cost components and see to it that they are properly loaded. Sacrificing, maybe it's actually the trade-off between the market share and also the earnings, and also the earnings which are risk-free. So I think from that perspective, perhaps the players need to be very mindful. But having said that, we have to keep in mind the ability of the borrowers also to service those loans. So I would say that, on the face of it, it looks like that it is easier to scale up. But the fact of the matter is that if at all one has to maintain the quality, one has to invest well in terms of sourcing, in terms of servicing, in terms of control, oversight. So those are the factors which have to be kept in mind while doing the pricing.
Mr. Khara, a lot of yes and no on what would be State Bank of India's approach towards their investment in Yes Bank.
Well, we have not yet deliberated the subject in the board of the bank. So it would be premature for me to really share my thoughts on this particular subject.
But in general, do you think eventually, it may be not in this meeting, maybe not in this quarter, but eventually down the road, SBI would be looking at exiting their exposure to Yes Bank completely?
See, we have to keep in mind that it's an investment which you have done. So we would be very mindful in terms of ensuring that we derive value out of this investment. So we will be very mindful in terms of how the markets are looking at the offload aspect, and how much we should do so that we don't destroy the economic value of this investment.
Mr. Khara, FY23 was about rising interest rates. It was about corporates repricing their loans. How do you see FY24 moving differently? Because at some point in time, sir, interest rates will peak out, but affordability will be challenged.
Yeah, I think I expect the year 24, the way the inflation trajectory is, I expect that in the year 24 we should see more of stability of the interest rate regime, and of course there is a component of the increase in interest rate and the ability of various entities to absorb this increase in interest rate. But I would say that if you really look at it, the kind of interest rate movement which has happened, and so long as there is an opportunity for the corporates to absorb or to pass it on, so they don't mind borrowing, and that's why the demand is very, very important factor. If at all there is a demand, then their ability to pass on the interest also is very much there. So I think I expect that, considering the demand which is seen in the economy and the kind of visibility of the demand going forward too, the corporates probably feel that it's an opportunity for them, and for that probably increased cost of borrowing is not as much of a deterrent. And we in any case expect that in the coming year there would be more stabilization of interest rate. So I think overall, I would say that they would be looking at it as an opportunity to really serve the demand and improve their turnover and improve their profitability too.
Mr. Khara, my next question perhaps may be slightly repetitive in nature, but I can assure you that every time we interact with you, this is one question or one answer which everybody looks forward to, which is that please understand from SBI chairman his view on the credit cycle duration. Do you see this 14 to 16% growth lasting for 2 to 3 years at least?
Well, of course, the kind of growth trajectory which is charted out for the economy, there is, I would say that there is a very, very fair chance of the system to witness this kind of a growth, for the very obvious reasons that the new growth levers which have come in, they're essentially in terms of, apart from the core sector which will continue to grow, because eventually infrastructure will depend quite a lot on the core sector growth, and that will also create demand for the core sector product. So that is one part of the story. But the other part of the story is that renewable energy, EVs, batteries, and when it comes to the new gen manufacturing, which is essentially in terms of which is induced on account of the PLI, and also on account of the fact that India offers an opportunity for a resilient supply chain. So I think these are some of the factors which gives a very clear indication that we will get to see a decent growth for a foreseeable future. Because as I earlier also I mentioned that, when it comes to infrastructure, it has got a significant multiplier effect. So that is something which will also drive a lot of demand in the economy, which will also, core sector, industrial growth will drive the demand for the consumer goods, will also drive demand for the agriculture. Lot many newer and more advanced agricultural technologies are being adopted in the economy. So I would say that the kind of growth path which you are following as an economy, it will unfold significant opportunity for growth for the banking sector too.
And at what point in time, sir, the NPA problem could surface up? Because, sir, it's a cycle. At the end of the day, banking sector goes through a cycle. At what point in time the cycle becomes red for you?
See, for the cycle, it is very important that there should be the practices in terms of underwriting, practices in terms of control and follow-up, they need to keep pace with the scale of business which banks undertake. So I think the last 2008 crisis and also subsequently 2014 events of AQR have actually helped the banks in strengthening their risk management practices quite a lot. And in the meanwhile, in the ecosystem, there are various developments which have taken place. The bureaus are there, and now with the help of CRILC, there is a very clear visibility of the borrower's behavior across the banking system. So I think that gives a very clear visibility in terms of the quality of the borrower. Apart from that, now there are entities like GST and etc., which gives a very clear visibility in terms of the borrower's activity level. So it is not merely the balance sheet, but it is also secondary validation through such tools also are now available for the banking system. So I think overall, all this has helped in terms of strengthening the underwriting practices of the banks.
Okay, that was our exclusive chat with the SBI chairman coming in. In the meantime, let's just take stock of what the market is at, and we're nicely clinging on to the session highs.